Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Welcome to Energy Unplugged. I'm Thekla von Bülow, co-head of advisory Central Europe at Aurora. My guest on the show today is Pierre Bartholin, senior director and head of revenue at Glennmont Partners. So who's Glennmont Partners? They stand as one of Europe's leading fund managers dedicated to clean energy infrastructure, boasting an extensive portfolio of 7 funds in total since 2009, with a total volume of 4 billion euros, and which translates into around 5 gigawatts of assets across 12 countries. Their investment expertise spans technologies such as onshore wind, offshore wind, solar PV, biomass, and also batteries, with a focus on projects across various countries in Europe, as well as recently extending to South Korea, which sounds pretty exciting. So my guest, Pierre, has over 12 years of experience shaping the carbon and power markets. He has an MBA from INSEAD and a master's degree from Sorbonne University. And since 2021, Pierre has been central to Glennmont's strategy in power sales and revenue generation, driving the firm's success in energy or renewable energy investments. So today's podcast will really focus on revenue strategies for renewable portfolio managers, and especially really deep diving on the topic of power purchasing agreements. I was also kindly invited to join Pierre's panel at the annual Resource Conference in Amsterdam in late October, where we discussed together with a panel the different perspectives on PPAs from the different market sides, be it developers, utilities, traders, or even corporate offtakers. So we will also use this podcast to debrief a little bit on some of the key insights from the panel. Pierre, thank you so much for joining me. It's really great to have you on the show today.
Thank you very much, Thekla, for the kind introduction. I'm very happy to be with you today, and I look forward to our conversation.
Excellent. So, I mean, maybe let's start off with really the big picture for our listeners. Maybe just if you can give our listeners an understanding of what are PPAs and why is this playing such an increasingly important role for a fund like Glennmont or generally as renewable developers across Europe.
Yeah, that's a very good question. So, what is a PPA? I believe that's quite a simple question, but I think the answer can be also quite complex. If I start with a basic definition of what is a PPA, so that's a long-term power purchase agreement between two parties. On the one hand, you will have the developers or the fund, which is managing the asset generating renewable energy, and on the other hand, obviously, you have the offtaker, which could be a corporate, a utility, or a trader. And at some point, we all need to come up to an agreement in terms of duration, volume, and prices. So that's a very basic definition. But I say that can be a complex answer because in the end, that really depends on the stakeholders and what they are looking for when they enter into a PPA. If you consider a player like Glennmont, so we are a long-term investor into renewable energy, we have quite a clear business model when deploying our equity funds. So we'll be sourcing some investment at different levels of maturities, depending on the technology. So that can be early stage for solar, that can be ready to build for onshore or offshore wind. We also have some assets which are already operating when we acquire them. And in any case, we definitely observe a trend of transiting from, I would say, a subsidized world, which will be relying on, CFDs, feed-in tariff, some very state-backed subsidy scheme, transiting to a merchant world where developers and asset managers need to fully rely on power markets to operate their assets. And that means that's where PPA become critical in the business model, because we're looking for two key, important factors when signing a PPA. on the one hand, we need to have very clear visibility on our cash flows so we can secure financing for funding the asset. So that's why we always need to have some bankable PPAs, and maybe we'll come back on this bankable concept. And also, on the other hand, as an experienced, asset manager, we have only a relative appetite for merchant risk. So, that's why we're always looking to hedge some of our revenues. And when you think that in the past 3 years, we experienced the two most extreme scenarios in terms of power prices being COVID prices, where, everybody stayed home, all the industry was shut down for a few months. We had record low prices in 2020. So that was clearly a worst case scenario on one hand. And also in the past 2 years, we have extremely high prices all over Europe. So that's where, you see PPAs as a very effective hedging tool to reduce the volatility and uncertainty around our revenues. And this is clearly why in Glennmont, we have set up this revenue team, so we can, get the tempo of the market, to be in contact with corporate buyers, utilities, traders. So, we can really get the best from the market and work with our investment team in charge of the M&A transaction as well as the project financing. So we can come up with a very optimal business case for all the projects that we're developing.
Yeah, interesting. And we'll talk a little bit more about kind of risk management, portfolio approaches, and what are our best practice around that. But yeah, indeed, I would just to complete that, we really came from a world where renewables were really built on a subsidized basis, and now PPAs are somewhat substituting this, while at the same time providing as much firm revenue or revenue security that is, for instance, as you mentioned, important for lenders. The maturity of the PPA markets are very different across the different European countries. So the Nordics and Iberia are very mature and quite liquid, whereas other countries are slowly emerging and it's becoming kind of more and more of a thing. But generally what we're seeing across Europe is that the counterparties for PPAs really very much used to be utilities from a developer perspective. So the offtaker would be a utility, and this somewhat has shifted in the last couple of months, especially. And so I was wondering to get your perspective on why you feel that we're seeing more and more corporates actually coming into this field, and would you consider closing a PPA directly with a corporate rather than a utility?
So the answer is yes, definitely. As of today, we're running 4 corporate PPA negotiation on the same time in South Europe and Asia. So yes, the corporate PPA market is mature, so depending on the countries, but we see a lot of interest and a lot of tenders are coming to us, seeking for, honestly, a lot of volumes in all European countries. So I would say, yes, this is a major market. Now, that doesn't mean at all that, we are not considering utilities as, great offtakers. And I think there are 3 components that, we take into consideration. Somehow the first component on the list will be sustainability, because when you think that, at least in Glennmont, we put a lot of efforts in the way we develop projects from a sustainability and ESG point of view. So it's not just about generating guarantees of origin, which are the certificates proving that the electricity is green. It's all about biodiversity, the quality of the development of the projects, et cetera, et cetera. So in that sense, when we are able to work with corporates to sign a 10-year PPA, where in the end, we embark on a very long journey with this offtaker, because we know that the asset will be attached to these corporates for 10 years, we see a high valuation of all those sustainability components in the project, because corporates are always looking for qualitative projects. So this is important. Then I would say a difference between corporates and utilities will be in terms of time management when it comes to negotiation, execution of a PPA. you can't deny that, despite having a bit more fluidity on the market, it takes much more time to negotiate a PPA with a corporate. And not to blame them, but, this is usually new. They don't necessarily have all the specific and dedicated team to negotiate such complex transactions. And also, when you think that, it can be 10 years for several hundreds of gigawatt hours of electricity, the notional of those contracts is very high. So that means in terms of approval within those corporates, that can go to the board or to the CFO level. Honestly, if I have to say that, you need to at least consider 1 year between the day we receive a tender and the day we can sign a PPA.
Yeah.
I would say at least.
Which can be a long time. Absolutely. Yeah. Transactions still take a long time.
Yes.
Yeah, for sure.
And that can be, I would not say a challenge, but, for teams like us, which are quite lean, that means we really need to select our takers to make sure that when we enter into a negotiation, this is going to end up in a signed PPA. Otherwise, it's not the best allocation of our time. When we consider utility or traders, that's their core activities to trade power. So that's much more efficient. That's for sure. And maybe the last item I wanted to mention is, of course, in terms of risk allocation, you can have a different allocation of risk when you negotiate with utilities or traders. When it comes to the shape of the product, credit risk, also, when do you take some projects to offtake market? Because you need to consider that corporate buyers usually are looking for an additionality concept. So that means they want the PPA to justify an additional capacity to be installed on the grid. So that means they wouldn't sign a PPA for an asset which is operating for a few months or few years. Whereas, utilities, they are much more driven by prices. And yes, they can sign a PPA for 7 years after a project has reached a grid connection. So in Glennmont, we're really agnostic on the type of offtaker. To us, it's what's the best fit with the project in terms of project finance, what's the maturity of the project, et cetera, et cetera.
Yeah, I fully agree. I think I would agree to all the points. From my experience working with the corporates, is just that you can't just put all the corporates in one bucket. There's such a big difference in terms of capabilities and know-how, how energy intense they are, how big is their stakeholder pressure to decarbonize, and so on, that are affecting their capabilities to go into a PPA transaction and close a PPAs. So I've seen companies that are extremely experienced, right? So if you talk about the technology companies that have been in the PPA space for quite a while and are pursuing a big portfolio approach. And very recently, we've seen quite a lot of additional corporates coming into the market. You mentioned the price volatility and especially the price levels in the last year have made energy intense companies realize that there's actually not only a sustainability aspect to closing a PPA, but as you mentioned, a price hedging perspective. And for a lot of them, it is quite a new thing to close a PPA, especially if it's such a long-term aspect, so long-term contract of 10 or even 15 years. The point that you didn't mention, which I think is really important, at least in the discussions that I've seen, is around credit worthiness of corporates to be considered as a counterparty, and also having an assessment how viable, how future-proof is that company, right? So 15 years can be a really long time. So and the world is moving really fast. So are you doing kind of an assessment around that when you consider a corporate offtaker?
Yeah, well, for sure. And I guess that relates to one of the first point I mentioned about bankability of a PPA. So, it's all about the credit support that we would get through the PPA in case of, termination of the contract. So for sure, to have investment grade credit support in place is a must, because that's what we get required from the banks. So that's as simple as that. So that means we have a pre-screening of what's the credit rating of the offtakers. And if it's a bit weak, there is always the option to put in place, some letter of credit from banks to make sure that our lenders will be satisfied with the conditions of the PPA. And also, there is a risk which is about reputation because, it's a 10-year agreement. So we will be, bundling our name and our projects to an offtaker. So the reputational risk is also quite important.
Yeah. And so you made a comparison also with the utility as an offtaker, which sort of is the classic structure of where the PPA market was coming from. And the reason why kind of also the utilities were looking at the corporate was that given that PPAs are substituting the existing subsidy schemes or even fading out subsidy schemes in some markets, there was the need for kind of a 10-year revenue security. And for utilities, it's actually quite difficult to hedge those type of volumes and for such a long duration on the derivatives markets. And so utilities or corporate off-takers on their end as being a viable mechanism instrument to hedge their positions on the downstream. However, the corporates are coming from a world where they are substituting their classic power procurement, I would say, with these longer term contracts and direct green contracts. And all of those different perspectives actually lead, from my experience, in quite different ways of how the different market participants are pricing PPAs. So I was wondering kind of what your experience is around how do we get to a consensus in the market on what the right pricing for a PPA is?
What is sure is that that's not an exact science. So you have more and more players, some facilitators providing some price indications on PPAs and trends, which are all very valid. But honestly, when you get to a very competitive tendering process, that's where you discover what's the real price that this corporate or utility is ready to pay. And that's easy to compare when we think of a fixed price, on a 10 years basis for a very standard project, a standard structure, but the fact is that we also enter into very different pricing structure, which could be some collars, which could be some discount to the day ahead with some floors. And then, it's very difficult to compare prices between very different offtake structures. So in the end, that's why, we rely on some long-term price projections, and you are very familiar with that, and that we have our own models to make such assessments. Because in the end, I think it's very important also for corporate buyers to understand that developers, we don't derive PPA pricing from the futures market. We are, an engineering company. We are developing some real projects. So we have some CapEx, we have some OpEx, we have some long-term price assumptions, but we build the PPA prices from our CapEx and OpEx contracts. So that's why we have sometimes a different approach than some utilities or traders, which are very screen-driven through the futures. And that's why, sometimes we are very competitive in some countries, a bit less on other projects. That depends also on the quality of the projects. And then I'm sure we'll come back to that, but there is also the notion of a portfolio effect. So if, I give you an example, today we have set up an IPP, which is called BNZ, which have about 1.5 gigawatt of PV assets to be connected between Italy and Iberia. And we consider this portfolio as a whole. So although you might have 25 projects within this portfolio, we take a step back and we look at the offtake structure and the prices, etc., on an aggregated basis.
Interesting.
And that's very important. Allows us, maybe to offer a fixed price, which is a very decent price in Italy, and to use that to maybe come up with a more innovative structure, which will be a monthly floor in Portugal with some discount to market, etc. And when you consider, 15 different PPAs and you aggregate all of them, that's where you see what's the contracted value of the portfolio. So we can get to some niche structure because we have such a diversification effect.
Yeah, so really interesting insights here, Pierre, especially on the portfolio effect. And I'll come back to that in a second. I'll just want to kind of front load one question, coming back to the prices. So the interest bit is that you mentioned you're looking at capex and opex, or levelized cost of electricity, as I like to call it. So indeed, kind of what we see from a lot of developers, or on the upstream side of the value chain, is sort of an HCOE plus margin type of approach. And the big question that we see in that type of world, if you look at from just a project per project perspective, is that the HCOEs will, or the capture prices, so the renewable capture prices, will fall under the LCOEs, on, in some cases, already are currently, due to kind of high material costs. And if the capture prices are below that, and you price it on the basis of futures, which are expected to fall on a lower level in the next coming years, together with the power prices. In that kind of world, we see a gap between the power on the market and the LCOE. So the question here is a little bit, how do you fill up the gap if you just look at it as on a project by project basis, or do you then have to look at alternative business models, or, as you say, in the portfolio effect way? Wanted to see if you second that view.
Yeah, I mean, is it fair to say that you're asking about, well, what happens to cannibalization of, for example, a PV asset or a PV portfolio, where in the end, the power price of the electricity on some monthly or hourly or daily time basis will be less than the LCOE?
Yes, exactly. So what we see in the different European markets, so Iberia is a good example, is with additional renewables coming into the system, the renewable capture prices, so the generation weighted prices for renewables are being cannibalized, meaning that solar assets in a region usually all produce at the same time when the sun is shining, and then those hours where the sun is shining, there will be a lot of solar generation, so that the prices will be low. And that is kind of leading to prices being fairly low. And a portfolio effect could be one way to look at it. But there's kind of new business models arising where the LCOE is not only looked at in the context of a specific asset, but also, for instance, in combination with a battery, or even a battery and an electrolyzer, for instance. So do you see kind of new business models emerging in a world that is much more flexible and more volatile than the world that we came from?
Yeah, definitely. Because where we come from was, kind of fixed price supported by a national government agency, which was paying a fixed price whenever we generate, even if it's at noon when, you might have a lot of PV on the grid with very low prices. So that's where we come from. So this cannibalization risk is very tangible. So we take a lot of assumptions, on such risk. And as you mentioned, we're looking at that from a portfolio effect. So we do sign some pay as produced PPA structures most of the time. So that means we get a fixed price from the offtakers, even if the price on the market is lower than the LCOE. We also keep up those risks because, we still have some merchant exposure to the market. So that means, when we just spill the electricity at the hourly spot rate on the market. But of course, we are quite proactive in finding new business model. One of them is obviously batteries. It's as simple as a kind of arbitrage strategy. You would be charging when the power is very cheap and discharging 2-3 hours later when power prices recovered. So as of now, we are looking at 3 co-located battery projects between Italy and Spain, where we put in the model the fact that those batteries will be mitigating this very temporary cannibalization effect. So I think that's a macro trend which is coming to the PPA market, how developers can mitigate that risk. And rather than, asking all the time for pay-as-produced structure, we can come up with a different approach to offtakers. And the second innovation is, in the end, you can think what utility have been doing for decades, which would be to aggregate some technology profile together. So let's say PV plus wind in the same PPA. So if we were to aggregate a solar shape and a wind shape, we will get much closer, not to a base load, but to something closer to a reduced cannibalization effect, because in the end you mixed the technologies and you mitigate each technology's cannibalization by the other, and we could potentially take more risk on that end if we come up with this solution. And then if you combine the two, PV plus wind plus battery within the same offtake agreement to an offtaker, I'm quite confident that in few years we can deliver some baseload PPAs and capture the premium which is attached to the baseload structure to corporate offtakers in South Europe.
Yeah, I was about to mention, right, because it's one of the biggest advantages to smooth out the generation profile. And even though you are delivering preferably on an as-produced basis, what the corporates are actually looking for is baseload, because baseload is much easier to integrate into their remaining power procurement strategy, and it makes it easier, for instance, for their power supplier to then kind of handle a profile if it's as smooth as possible. So indeed, I agree. It sounds like if you were able to get at least somewhere close to a baseload, this would make it even more attractive for the corporates.
Yes, exactly.
Really interesting. And so I'd like to come back to that portfolio part, because I think that's a fascinating one. So when I talk to developers, at least for the moment, what I oftentimes hear is we want to de-risk as much as possible the SPV, so as such the project, because you're looking for some debt financing specifically on a project by project basis usually. And so that makes it actually quite difficult to take on a portfolio effect if you're looking to maximize the value for each project individually. And your approach sounded a bit differently and a bit more innovative in that sense, that you are actually looking at the portfolio, both in terms of looking for generation profiles that don't correlate too much between the different countries, but also use the multi-country approach to, for instance, sort of somewhat cross-subsidize more favorable countries and less favorable countries. So what is Glennmont doing differently here?
Yeah, thanks for asking. So that's really, I think, the topic which is most exciting for me for the past 12 months is how to take our Glennmont portfolio to this, tangible diversification effect, and how we can translate that into, euros. And I'm going to expand on that. So when you think that, in our Fund 3, for example, we have about 850 million euros under management, and we have some onshore wind in Finland, we have a lot of offshore wind in Germany, we have some PV in South Europe, We have a battery in Finland. So all of that creates, of course, an implicit diversification effect. But now the target is really to convert that into hard numbers. And the way to do that is, well, first for us to deploy some new solutions to analyze all that and somehow to run some Monte Carlo simulations on different parameters. Because when you think that we have onshore wind, offshore wind, PV, but also Nordics, France, etc., we get exposed to different markets, different technologies, etc. So what we do is to stress some of the parameters of the portfolio. So what if we generate a bit less wind, but more PV? What if the Nordic countries have low prices in the coming 6 months, but higher prices in Spain, etc., etc. So you stress all those parameters and you can convert our portfolio effect into numbers. So because we have different PPAs and such exposure to different countries and technologies, well, this fund number 3 portfolio effect can be valued at X million euros because we know for a fact that we are protected against extreme scenarios. So that's the way now that we drive, revenue and offtake strategy is by understanding what will be this additional PPA or this additional project meaning into the existing portfolio. So we are really moving away from just the SPV project finance approach to something more comprehensive. And that's, also valid for our next fund, which will be about close to 2 billion euros of assets under management that will help us to build a stronger offtake strategy and potentially to offer innovative offtake structures to some corporates in some countries because, well, that's bringing a lot of protection to the existing structures that we have in the portfolio.
Yeah, really interesting. And you're mentioning a lot of points, obviously, that Aurora is also looking into a lot, such as weather sensitivities, as you mentioned, depending on whether the weather patterns will change or even the climate. This can have quite significant impact on the amount of wind yield in a year. So 2022, for instance, was a year above the energy crisis was also actually a really bad weather year for wind. And running these, we actually do the same. We also do Monte Carlo simulations where we look at kind of the different weather patterns and how they correlate and also how they affect the PPA prices. And the other bit, obviously, is also commodity price scenarios. So what are the deviations, for instance, of a central price scenario due to the shifts between the different countries. So it can be different developments in prices due to national reasons, but also commodity prices, other developments around demand and renewable build out in the different countries that obviously can then have significant impacts on topics such as cannibalization and generally the power prices. So definitely kind of a multi-scenario approach and calculating the correlation not only between the technologies, but also between the different countries is really beneficial to assess what is the price and volume risks of a portfolio. Yeah, super.
And go further, I mean, that's really a, kind of energy risk management, which has been applied to other commodities for quite some time. So that's really coming to the industry now. And that also can be translated into, well, how do we proactively manage our merchant exposure? So that will be everything which is not sold through a feed-in tariff contract or a long-term corporate PPA contract is kind of exposed to the day-ahead market, which can go as high as 500 euros per megawatt hour or -10, and that's very volatile. So that takes us to a further step, which is, well, now we're currently signing some ISDAs, so some derivative contracts, so we can also proactively manage this merchant exposure for next month, next quarter, and we get very positive feedback from our investors because they understand that we are not just passive day-ahead price takers, but we have a view that if, as of today, the futures market in Finland for the months of January 24 is offering me a value which is in line with my original, assumptions, there is no reason I shouldn't lock that in. And that's really a next step in terms of energy risk management.
Yeah, interesting. And just to finalize kind of that, those different considerations, talking about the lenders again, there's also something that we discussed on the panel at Resource. So what is your perspective on dealing with lenders and in relation also with this more portfolio approach rather than an SPV approach? Have they slowly become a bit more comfortable with kind of more innovative, more flexible structures, or is your impression that kind of a lender is always looking for the maximum security possible?
Yeah, I mean, of course, it's about security and bankability and everything. But yes, we have very, positive discussion when we explain our approach, why it makes sense. And in the end, why is this beneficiary to the SPV or to the holding company, which is obtaining the financing. So I would say, of course, lenders are also learning with the market as, different players do. But it's not binary as well. You need a strong PPA for 10 years, 80% of the volume, etc. Now you have much more consideration on the portfolio effect, on the merchant management, on cannibalization risk. So I would say, very positive outcome. Well, it's not necessarily my field of expertise, but I feel the lenders are more comfortable with more innovative products now.
Yeah, it's also my impression. It depends a little bit on the market, I have to admit. But in general, I have the feeling that on the one hand, it's actually more banks that are becoming active in the field, which was usually kind of one or two banks per country. But it's becoming something that more banks are comfortable with actually looking into PPAs. But also in the current credit environment, banks are actually looking to broaden their perspectives and their approaches, both in terms of pricing, moving away from just a fixed price, 15 years PPA up to more flexible structure. You mentioned collar floating structures, or even a merchant knows in some aspects, but also looking somewhat into different volume structures also. That's what I'm seeing in the market. And yeah, so really interesting, Pierre. So they're kind of getting slowly to the end of the time. So just one final question, because you've actually asked me the question on the panel 2 weeks ago. I was actually keen to hear your perspective on it. So you asked me what would it take basically to accelerate PPA transactions, and how can, for instance, more of a standardization of PPA contracts help? So yeah, same questions to you basically. What would you see as, for instance, countries where it works better, and why does it work better there, and what could be done to standardize PPA contracts?
Yeah, well, it's I think it's interesting because, well, depending on your experience in terms of negotiation, you can say, well, I do believe that there will be standardization and it will be always be more fluid, etc. Honestly, I'm a bit doubtful on that, in the sense that, as we already discussed, for some big corporates, those contracts are rather very complex. You have a lot of moving parameters, and it takes a lot of time for them to understand all the pieces together. So I'm very supportive of all the intermediaries that help to fluidify the market. So, when we have some intermediaries and consultants helping corporates to go through the PPA journey to understand all of that, and then which take those corporates to market with tenders, I think it's very positive, because that's not something that a developer or a PPA seller can be doing, because that's, a lot of work. And then, competitive processes work quite well. And then we enter into the hard phase, which is term sheet negotiation, PPA negotiation. And yeah, it can take a lot of time. So what is good is that you have more and more players signing PPAs. So the experience is, growing on a daily basis. I was looking at numbers and the first resource conference I attended in 2019 had about 65 corporate buyers, which was already okay at that time. And the one we attended both last week had more than 350 corporate PPA buyers. So that's just to show you how big this market is growing, and the more players, the more experience that there will be in the industry. So in the end, what we're looking for in Glennmont is that if we have one counterpart with which a PPA negotiation went well, we are more than happy to just duplicate this in a different country or even in the US or in Asia, because we all save a lot of time then.
Yeah, so kind of strategic partnerships can be very interesting. Yeah, indeed. So I think the market is talking a lot about more standardization of contracts. But for me, it's less about the standardization of contracts, because there's for good reasons contracts are geared towards the individual project and the different parties. But it's more about the number of players that are active in the market, the knowledge that is being built up. And indeed, we saw kind of the amount, the way resource has grown over the last years was really quite impressive in terms of how many market players were there. You mentioned the corporates was quite impressed by how many developers were there at the conference. Showing the additional importance of those direct corporate PPAs between the developer and the corporates. And obviously kind of the experience of the advisors for sure, and not only the commercial PPA advisors, but also obviously the legal advisors is really important in this context. So market maturity and liquidity is a big one for me. In this respect. Excellent. So Pierre, thank you so much for your time today. It was really pleasure to have the second conversation about this after the first panel around two weeks ago. What really is striking me is your approach around portfolio management, and also how you look into the new technologies such as batteries, but also hydrogen, which we didn't touch upon too much today. But there's a lot that is going to come, and much more innovative structures that I'm seeing emerging in terms of renewable build out and in context of PPAs. So exciting times ahead.
Thanks, Thekla. Yeah, that was very, very insightful. I think we could go on for hours. There are so many different topics, but for sure, these times are very exciting. There is a lot happening. And in the end, we should never, lose focus on the fact that all those projects just, add some new green electricity on the grid. And I think that's extremely positive for Europe and all other countries where we can develop new projects.
Absolutely. No, thank you so much for joining me today, Pierre. It was a real pleasure. And let's catch up soon.
Thanks, Thekla.
That was Thekla von Bülow, Aurora's co-head of advisory for Central Europe, talking to Pierre Bartholin, Senior Director and Head of Revenue at Glennmont Partners. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.